Yeah, it's also like it's like I didn't tell you to do like it's not my problem. Like don't do anything about it.
I feel like all I did was read the thing. I was like, okay.
Yeah, you definitely could have gotten away with
Like
it. I find I did a lot better on the midterm than the final, and where I actually like read the stuff.
A couple of administrative items. Anybody still on the wait list for this course? My understanding is that will be taken care of. I've gotten the approvals to have everybody cleared off of that. I think the administrative people are just a little swamped right now, but that should be coming through. So coming into the course, we'll get that taken care of. And then we'll like students turned away that want to take the course. Secondly, the textbook. Okay, so we'll start off talking about some of the legislative changes that have happened. And so this is just a function of being in the tax course. Things change quickly, and so textbooks are always trying to catch up. And so I would prefer you to take to have the 2026 edition of the textbook. And I think the bookstore has switched to that now.
When you're on, also for the online version on McGraw-Hill, it says that it's like 2025 or something, but then next to it it'll say current. And then when you actually like rent it and download it, it says it's 2026.
Okay.
So it's like, look for it just to say current. It's
Yeah,
like
because
labeled wrong.
they have an evergreen model where they update the online version like real time. And so, I'm just curious, did everybody do the electronic? Or do people still like the hard copy? Anybody do the hard copy? Back when I went to college, we had backpacks that were stuffed with cards, and it literally hurt your back during the rest of the day. I do like the electronic copy. So, yes, that's good to hear. So you guys should all have that. But let's make sure we're all in the 2026 version, because what will happen if we're not, the examples will be different in the slide decks, and when you're presenting the examples, will throw you off, and then tax is hard enough without having to deal with you. Okay. All right. So I want to pick up with a few things on just general on how to migrate from being a student to starting blossoming into becoming a professional. So we talked about this first one here, preparation, presence in the meeting, followed by a retroactive look backwards. It's being very similar to this 3-3-3 model. If you start that mindset, it'll suit you well when you get into the real world about how you approach your career and how you prepare and invest yourself in your career. I think that's very applicable. A couple other things on this list that I want to talk about. Treat others as if one. What I mean by that is everybody you encounter here, just start treating them as if they were your best client. You are already at a firm or a company, and this is your client, and you're working on behalf of them. Because I think people always think of, I treat my clients the best, right? Because clients are very fickle. They don't like the way they're treated, or they don't feel like they're a priority. They go to somebody else, go to a different firm, go to a different advisor. And so it's very easy to fall into the trap of, I treat my clients really well. But I think it's just a good habit to get into is think of everyone you encounter as a client. The person sitting next to you, the administrative person you're dealing with, the advisor you're dealing with. Treat them as a client. What does that mean? Be punctual. Treat them with respect. If they send you an email, respond to the email in a reasonable amount of time. Right? Be friendly to them. If you just adopt this mindset, it's going to be so powerful for you because what you find in the marketplace is you'll never know who actually becomes your client. Okay? I had so many people that I worked with. Not everybody stays in the same location, right? People change jobs. You're going to walk into a conference room, somebody's going to be sitting there representing a company, and you're going to be like, oh, I used to work with that person. You're going to hope that you had a good relationship with that person. I had situations in PwC where people that worked for me in my group ended up being my boss. So they went and started working at a different office, and they got very interested in the way the firm manages itself, got promoted and everything. And can you imagine that if I treated people that are working for me on a day-to-day basis, you know, maybe not the best, and then all of a sudden the tables are turned and they're my boss. That's just, if you treat everybody with respect and as a client, it'll suit you so well, because some people will become your client and they become your boss. You want to have a nice relationship with all those people. So I think we can practice that here. You can start developing that mindset with just everybody you deal with. You're in a group environment, group project, carry your weight, meet the deadline, be an active participant, help others on that type of thing. That'll suit you so well. The last thing I will mention down here on this, last two, is maintain a robust to-do list and restack it often. I love to-do lists. I have my work one, I have my personal one. But I think that's just a way of how you balance all the different things going on. And it helps you treat everybody as a client, right? Like, do I gotta get back to the advisor? Do I gotta talk to the professor? Do I gotta do this? Do I gotta do that? But maintain that to-do list. Don't lose sight of those things. And then what I would always do when I was working, I'm still working, but when I was working harder than I work here, on Sunday night, I would restack my to-do list, because your priorities change, right? You don't just, the last thing you put on your to-do list might be the most important thing you need to get done. So restack it, put that as number one. Address that first thing, right? Don't put off the hardest thing till the end. Address it now. I think that's just a great way to migrate from campus to being a professional, because when you're the low person on the totem pole when you first come into an organization, you're going to be in charge of a lot of things. And I really liked the young people. You don't have all the knowledge in the world. You don't have all the experience in the world. But I wanted you to master the facts. Like, when did we tell that person we were going to get back to them? Or what was our to-dos from that meeting? I love it when somebody said, oh, we're supposed to do this, this, and that, and those two people are on schedule, this person's falling behind, right? Just get in that mindset of just being able to, I always know what I got to do, and what's the status of those things. And all of this filters into the last point there, which is, like it or not, you are beginning to build your personal brand. And that can either get off to a good start, or that can get off to a bad start, right? Are you conscientious? Are you approaching this as you are beginning your career in whatever area is of most interest to you? But when you start day one at a company, you are building your personal brand. Are you highly technical? Are you a good communicator? All of these things will start building, and it's really hard to change once you start down a path. It can be done, but it's much simpler just to start off building your good personal brand. One of the things that I think can work well in this area is you can do it here on campus as well. You can do it when you first start your job, is observe other professionals. How do they behave in a meeting? How do they interact? What's the small talk before the meeting, small talk after the meeting that they do with clients, maybe more experienced people? You could borrow different pieces of professionals and start building your personal brand. It's like, oh, I really like how that person's in front on the whiteboard drawing pictures and leading the meeting. I'm going to start aspire to do that. Or I really like how that person deals with conflict if it's a feedback situation. Maybe I'll ask them, how do they get good at giving feedback? It's so hard. It's hard for me to give feedback. But if you can borrow different pieces of that, because I don't think there's ever one professional that's just perfect, right? Nobody's ever perfect. Somebody's got strengths and things they're working on, and others got other strengths and things they're working on. You borrow different pieces of them, you can start building your personal brand. But I think you start doing that here. Don't wait until you start your career. Okay? It's all part of this stuff. Just, yeah, you're in school here, but you're really transitioning to the real world. Okay. On substantive matters. So I want to get back to the reasons why our textbooks are different and everything. So we had a seminal piece of legislation last year. It's the One Big Beautiful Bill Act. It was signed on July 4th by President Trump. It was the impetus behind this bill was the changes on the international tax front. You go back to Trump 1.0, 2017, they enacted a major piece of legislation, the Tax Cuts and Jobs Act, TCJA. Your professional tax people talk about that all the time. It TCJA was passed through a mechanism called budget reconciliation. You hear the politicians talk about this quite a bit now, but you get a limited number of instances where you can move a piece of legislation through Congress with a simple majority approval. If you've been following the politics, and it's going to be fascinating as the months come up because we're going to be moving into midterms, but the House of Representatives is a very thin Republican majority. So they have limited instances that they can move legislation through with just getting Republican votes, not needing to get any Democrats to bring grants. And so the Tax Cuts and Jobs Act went through this budget reconciliation. Not one Democrat voted for it. That's good if you're on the proponent of pushing through the legislation. The downside of doing so is you have to be within budget reconciliation neutral to the deficit, neutral to the budget in a 10-year window. So if you're cutting taxes, you have to have offsets within 10 years to be able to meet that rule, right? You can't just cut, because then your math's not going to work and you'll fail the various parliamentarian mechanisms in the government won't let you pass that legislation. So you get this really unfortunate issue in tax legislation where they pass a law, and the terms of that law will change in the future just by virtue of the calendar changing. They don't have to do another piece of legislation. So they enacted these tax cuts that were within 10 years going to increase again, just by virtue of whenever I get there. And you might say that's short-sighted, but it's also part and parcel of our political system where we did this in 2017, and they had things changing in 2026 in that piece of legislation that they would count as an offset when they were doing their 10-year budget computations. And a politician in 2017 thinks 2026, that's eons away. I got to get elected 2 more times or whatever. And that's somebody else's problem to deal with. But it comes. So, giving you a little background here, that's what was the impetus behind the One Big Beautiful Bill Act, is that day of reckoning was coming January 1, 26. Individual tax rates and tax liabilities were going to go up. And if you know anything about politics in the United States, a sure way to not get reelected is to raise someone's taxes. They feel that directly. And no one campaigns on raising people's taxes. So the government mobilized and felt the need to pass legislation to stop that problem from happening. It's the One Big Beautiful Bill Act. What they did is they pushed out those changes that were going to come. And so you hear a lot of noise now in the political world about there's going to be a big refund season on the individual side, because what they did, they changed this law in January 4th of 25. They didn't change the withholding that they were doing on people's paychecks in the second half of 25. But their tax liability that they're going to start preparing here in a few weeks is going to be less than their withholding on a kind of macro basis. So there's going to be a huge amount of refunds coming to individuals. I say huge, but a decent amount of refunds coming to individuals, and you will hear politicians talking about it. The affordability problem, here's more money. You're going to hear people complain about inflation, the inflationary aspect. But anyway, I'm just giving you a little background of why this legislation happened. So, we knew we had this individual tax problem that had to be addressed. When corporate America knows there's a tax bill mobilizing, they are extremely well advised. They lobby, which means that they talk to their politicians. In the United States, we have this very interesting way of enacting laws, is that you can get access to a politician very easily. Believe it or not, wherever your home is, you can call up your senator or your House representative. You might not be able to talk to them personally, but you can talk to their office. And you can complain about something, like, I don't like this piece of legislation, or I think this person should vote in favor of this piece of legislation. Corporate America has been doing that for decades. There are lobbyists out there that help them do this. So when they know a bill is being mobilized, they come with their wish list. here's the stuff you should also put in that bill. So it wasn't necessarily the impetus of corporate tax changes, but they piggybacked on the individual tax changes to get things that they wanted in. So I just want to kind of go through a few things we're going to be covering throughout the course that have changed by virtue of the One Big Beautiful Bill Act. But I want to keep this thing as current as possible. And these are things that corporate America wanted in tax. Okay? So the first thing, just in a broad area on the corporate tax front, is capital investment. So this is property, plant, and equipment. Whenever the government wants to spur the economy, one of the first things that they look at is how do we allow for tax depreciation on capital investment. So we'll have a whole chapter in chapter 2, I believe it is, of property acquisition and cost recovery. That is this topic. I acquire capital investment, property, plant, and equipment. How do I depreciate that through my tax liability? When I depreciate it, I get an expense, depreciation expense. That's deductible on my tax return. Okay? What they do in this area is they tweak these rules all the time. So remember, accounting from a depreciation standpoint is based on useful life, estimated useful life based on management estimates. Tax is very rigid. You'll see that in chapter 2. We tell you the exact rules for the exact class of property. This is the way you depreciate it for tax purposes. Hence one of the reasons why we have a book tax difference always on depreciation, because accounting does their thing, tax does their thing. So what happens here is the government has increased 100% expense. Okay? Meaning that if you buy a new piece of machinery, you buy a new piece of equipment, upgrade your IT system, you get to immediately depreciate that in the current year of the investment for tax purposes. Accounting's going to keep doing what they do, right? Don't care about tax. Tax changes the law, 100% depreciation deduction. The idea is, if I allow you to pay less tax by virtue of depreciating all of that investment, you'll do more of that investment. You're sitting on the fence of saying, oh, well, we were going to buy that new piece of equipment in the next couple of years, and the tax person comes to the meeting and says, hey, we should do it this year because we get a 100% deduction, right? It's going to incentivize management to make that decision to purchase that equipment. You purchase equipment, somebody's got to make the equipment. Somebody's got to make the equipment, they need to hire people. So it's that whole spurring of the economy. What's going on in the landscape now with those refunds, plus this type of thing is the Republicans want to hold on to the House in the midterms. So spurring this economy, getting more good GDP numbers, employment numbers is what they're going to be touting. November will be here before you know it, and you'll know it's coming because your TVs will be filled up, your computers will be filled up with political ads, because the whole House of Representatives gets re-elected, right? And usually the presidential party in power loses seats in the midterms. That's just, I hope I didn't mention it to you, but I mentioned it before. The most popular football player on the team is sometimes the backup quarterback. So usually whoever's in charge loses some seats because people just complain about whatever's going on. However you feel politically, I could probably all agree that there's a lot going on with this administration. So they're incentivized to try to keep control of the House, so they're going to do what they can for the economy. This is one way they're going to do it, is through capital investment. Research and experimentation. So what they did in that Tax Cuts and Jobs Act, remember, so the big thing that they did is they took, from a corporate tax perspective, is they took the corporate tax rate from 35% to 21%. Massive reduction. 14 hard percentage points reduction in tax is a massive number. Why did they do that? They wanted to make the U.S. more competitive from an investment standpoint around the world, so they lowered the corporate tax rate. 35 is at the highest compared to other countries. 21 is like in the middle. And the idea is the U.S. doesn't have to be the lowest. We've got a lot of other things going for us with consumers, natural resources, education, as you guys are a part of. All of those things make the U.S. special. So we don't need the lowest tax rate, but we don't want the highest tax rate, is the idea. But think about, okay, I got to be neutral in a 10-year window for that piece of legislation in 2017. I lower the corporate tax rate, even though it's 9% of that pie I showed you on Monday. We're going 35% to 21 is a big, I got to fill that in somehow. One of the ways they did this was research and experimentation expenses. So these are, think of your white lab coats. So anybody in the pharma industry doing research, anybody in the high-tech industry doing research, the historical norm for those expenses was immediate deduction. Okay. Tax Cuts and Jobs Act in 2017 made companies capitalize those expenditures and amortize those over 5 years. Okay, so that's postponing those deductions. That raises revenue, right, to the government. And guess what corporate America thought about that? Not very much. Right? They like their immediate deductions. That first topic we talked about, capital investment. We want deductions now, postponing my R&E expenses. So what did they complain? You really want me to hire less people? You want me to do less R&E in the United States? You want me to do it outside the United States? Government, no. So they went back and changed it back down to 100% deduction for those expenses. Again, they fall into the corporate tax. Interest expense. So interest expense on borrowings for a corporation. That interest expense changed in 2025 or 2024 from EBITDA to EBIT. So when we get to that rule is 30% of pre-One Big Beautiful Bill Act was 30% of EBIT, earnings before interest and taxes. Okay. Prior to that, from 2017 to 2024 in the Tax Cuts and Jobs Act, it was 30% of EBITDA. The DA is depreciation and amortization. So if it's before those expenses, the base is higher times 30% is the limitation. My expense deduction is higher. So those companies that are leveraged and borrowed a lot of money, interest expense is a big item. The interest rate environment has been going up, so more costly to borrow money now. So more companies are facing pressure to get bigger deductions on their interest. So there was a cry to bring back the DA. This is tax humor. So bring back the DA. But they were banging that drum for years. They got it in this legislation. The government added it back in, so it's EBITDA. So all three of these are corporate America favorable. They got these back in. Okay. Okay, so just a little bit on the details. On the depreciation, and we'll cover this. Pre-One Big Beautiful Bill Act, only 40% of the cost of the eligible property was immediately expensed. I said we go back to 100% of that for property placed in service after January 19th of 2025. The reason you see, when you see weird dates like that, like a not a clean cutoff, like usually tax law starts effective January 1st, but this was January 19th because this is when they started talking about this. And so they said, okay, if you were from January 1st to January 18th of 2025, you already bought the equipment. You weren't doing that because we changed the law. So you're in the old law. So anyway, that's just a side of why you see these weird dates sometimes in legislation. What they also added, and this was a Trump administration initiative, was long-lived real estate constituting what is called qualified production property is now eligible for 100% expenses. These are manufacturing facilities. Now, there are very specific timelines that we'll go through when we get to Chapter 2 material, but these items were extremely lengthy depreciation lives, like 30 years. Now we can do those within the year of placed in service when it goes live. And what is this for? These are for incentivizing U.S. manufacturing. Right? qualified production activities. They're qualified because they have to be in the United States. So this is a company sitting there thinking, am I going to build my next facility in Missouri or Mexico, or Missouri or Canada? Guess what? This is now, we're tilting the scales to where do it in the United States. Will lower your tax liability. So again, part of the Trump administration mindset. I put down here, this is a permanent provision. What I mean by that is the terms of the One Big Beautiful Bill Act changed it back to 100%. It does not sunset by the terms of the One Big Beautiful Bill, which is unlike the Tax Cuts and Jobs Act, which was in its terms is going to change once we got to a future year. But what this doesn't mean is it's permanent from it can never change. There is nothing permanent in tax law. Right? It can change. You just got to have a new piece of legislation to change it. So that's what I mean by permanent, is it doesn't sunset by virtue of its own terms. You have to have new law introduced, get the votes, get the president, whoever that is at that time, to sign the law. You do all that, you can change this to however you want. So when somebody says something's permanent, yeah, it's permanent for now. It's not permanent forever. Okay. Interest expense. So that was the 30% EBIT. Now it's back to the DA, 30% EBITDA. This was retroactive back to 25. So corporate America even got it pushed back to January 1 of 25 in the aspects of this. And it's also a permanent provision. One thing corporate America really likes, even though what I just said is nothing is truly permanent, they really dislike the sunsetting of things that the government does because of playing budget games. They like to have something that they can forecast, right? The CFO and executive leadership is always trying to project future results. And tax is one of them, right? They gotta project sales, they gotta project inventory, everything they gotta be projected, but tax is one of those items. And they just really dislike this enacting of a law and its sunsets and all this type of thing, this budget gimmickry, if you will, that goes on. They like this permanency of this. They can deal with if the law changes, because think of the CFO and the quarterly earnings call. I can say, well, the law changed, it's certainly going to affect me, it's going to affect all my competitors as well. But I like to be able to, absent that event, I like to be able to plan in the future. So I can't plan as to what the future political leadership is or what they're going to do or can they get the votes and pass law to change, but I do want to be able to plan as best I can. So they love these permanent provisions. The R&E expenses, again, were capitalized and amortized over 5 years. Now we get current expensing in that. That was also retroactive to 2025 and a permanent provision. We'll cover all these topics when we get to that subject matter. I just want to give you a flavor of the big change that's going on. Okay. We also cover partnerships here, secondarily to corporations. Not nearly as much. Not nearly as much change on the partnership front. Partnership law, as I mentioned last time, is extremely complicated. We scratched the surface of it in this course. But main changes were, when you cover, we'll talk in a moment here, partnerships are flow through. If the partnerships don't pay tax, all the results flow through the partnership and are reported by the partners on their tax returns. So many partners are individuals in partnerships. So all those individual tax changes we talked about in taxation of individuals, all the things that were spurring the One Big Beautiful Bill Act because potential increase affected partnerships indirectly because that income was going to be taxed by a large number of individuals. And so that individual tax changes affected them. But the core partnership rules haven't changed. The one thing that did impact partnerships is a concept called qualified business income, QBI. This was when the corporate tax rate in 2017 went from 35 to 21. Politicians came to the view like, well, what about all of our flow-through businesses? We have a whole segment of society that is not, business is not done in corporate form. Are we inadvertently incentivizing corporate solution versus flow-through transactions. So they enacted the qualified business income deduction regime, which equates to flow-through income to be taxed with a 20% deduction of that income. So effectively 80% of flow-through income is taxed if it's eligible. That was to sunset in 2026. So the one partnership change that they did to do indirectly is extend the QBI provision, and I believe that that is made permanent as well. So that was mainly your small business people saying, hey, you like all these corporations and big business, but don't forget about us. We employ a lot of people as well, and so they made that. Okay, let's go to the Chapter 4 material, and I tweaked the Chapter 4 material that we're going to cover slightly. Just touch upon this to give you a little bit of flavor on business entities. So we'll cover the second part, if you will, of Chapter 4 more sequentially than we did Chapters 2. Okay, so I want to talk about legal formation requirements because it's really hard to separate legal and tax when you're doing these things because there's a legal mechanic as well. Not just that tax is law-based, but the mechanics of getting a business entity up and running and the consequences of your choice of business entity has a legal implication as well that we want to make sure you're aware of. And then that goes part and parcel with the non-tax characteristics of these entities. And then separate tax paying versus flow through. I want to make sure we're level set on that. And then legal form versus tax treatment. We have some hybrid entities that we're going to touch upon, where the legal form gives you one thing, but the tax answer is a different thing. Cover that. And then converting between business entity types. There's a very entrepreneurial mindset on this campus, so a lot of people, your friends maybe, have a business or thinking about starting a business. How should I start? Be an LLC. My uncle said over Christmas I should be an LLC. We'll talk a little bit about that, but many times where you start is not where you want to end up. So I may start as a corporation or I may start as an LLC and I decide I want to do something else. Can I do that? So we'll talk a little bit about how do you convert once you already part of something. And is that taxable? Okay, so when you're embarking on a new business venture, an owner can choose to organize their operations as one of several business entity types. You can be a sole proprietorship. That is what we talked about in individuals a little bit. That is you doing business in your name. Okay? You remember in that class I talked about Jeff Plunkett, CPA, putting out my shingle, hey, I'll help you with your tax returns. That's a sole proprietorship. It's just me. Nothing else. There's no, the state's not involved, the federal government's not involved from a formation standpoint. I'm just deciding to start to do that business, right? That's a sole proprietorship. It's one person doing business. If you're in the gig economy and you're freelancing, doing something, or you're a musician and you do some stuff, you are a sole proprietor. If your activity rises to the level of a business and it's not a hobby, but if you're doing something and you're getting paid for it, and just you, then you're a sole proprietor. Contrast that with a partnership. Partnership just has to be more than one person. If you have one person, you are not a partnership. It should be more than one. And it could be as any number you want. I think PwC is up to like 4,500 partners. Massive, right? Very large accounting firms, law firms, investment firms can be structured as partnerships because you have unlimited number of partners. That can either be technically a general partnership or a limited partnership. Okay? A general partner has unlimited liability. I'm not talking about tax liability. I'm talking about legal liability. Think worst case, something goes wrong. Hard to think about in an accounting world, like from a physical standpoint, people don't usually get hurt doing accounting. Maybe get a paper cut, but you don't usually get hurt. But what if you're in a transportation business, delivery business? You can have a car accident. Your delivery person could hit somebody, do some kind of property damage or something. So that liability who is liable for that damage, right? So this is apart from insurance, this is just a legal concept. And so a general partner doesn't have that limited liability. Limited liability typically means that the maximum amount I'm exposed is the amount I've invested in the business. If I'm a general partner and I've put $10,000 in the business, my liability exposure is not capped at $10,000. Everything on my personal balance sheet. Contrasted with a limited partner in that hypothetical, limited partner putting $10,000 in the business, the worst I can ever lose is $10,000. A limited liability company, an LLC. This is a creature of state law. You file a few pieces of paper online. You can probably do that during the course of this class and have an LLC. But an LLC is a entity that provides the term limited liability. It provides limited liability, meaning that the only amount that you're at stake is what you put into that business. Your home, your car, your retirement savings, your savings account, not part of that equation on a worst case scenario. Okay, so limited liability company. Very similar to a corporation. Corporations have higher limited liability, so everybody is a limited owner as shareholders. The only amount you can lose is what you put into the corporation. Personal assets are safe. Okay. Now, a corporation can be either taxed as a C corporation or an S corporation. The C and the S are just the subchapters of the code that deal with that particular legal entity. So, a C corporation is under subchapter C of the Internal Revenue Code. S corporation, subchapter S of the Internal Revenue Code. So, when people say, most people when they say corporation, they mean a C corporation. If they intend to refer to an S corporation, they will say S corporation. Okay? Your big publicly traded companies that we all know, the big behemoths that are out there, they're all C corporations. There are some massive S corporations out there. They're just not public, because we'll talk a little bit about the features of an S corporation that limit its ability to be publicly traded. So they're usually closely held family businesses. When I mean closely held, like there's a group of shareholders that are typically related, I think, most times. But it's not, you're not, I couldn't be a shareholder in a lot of S corporations. Family doesn't have business. So big ones that are out there that you may have heard of, they're just not public, but they're certainly doing business in the world. Coke Industries out of Wichita, Kansas, massive company. The Coke family owns that. It's an S corporation. We'll talk a little bit about the features of why they chose to become an S corporation. Cargill out of Minneapolis, massive. Okay, so don't equate, as a general matter, they're typically smaller family-owned businesses, but you can have some behemoths that are out there that just there's just some limitations on the public trading. But guess what? The families behind Cargill and Coke don't want to be public. They want to own everything. So that's basically it. There are no other like vehicles that are out there. There's trusts and estates, but those are kind of like separate things. But for business activity, it's a sole proprietorship, it's a partnership, it's an LLC, or it's a corporation. That's received for you. Okay. So the good thing is we don't have to know 50 different legal entities. Yes.
Also such thing as an LLP.
Yes. Yes. So a form of partnership. So the question was an LLP. It's a limited liability partnership. So your big accounting firms are LLPs. Okay, you just don't see that at the end of their name, but the technical filing of PricewaterhouseCoopers is an LLP. So limited liability partnership. It's trying to give us. You hear me talk about when I talk about business entities. These kind of little weird ones are trying to give you the best of both worlds. Partnerships, from a tax perspective, have a certain allure to them. Single layer of taxation we'll talk about in a moment. But I don't want to step into the shoes of that liability, that unlimited liability aspect, which makes it very messy, right? Because what can happen in a big accounting firm, you can blow up an audit. It's happened. When the audit blows up and a client goes bankrupt, accounting firms are one of the first ones that the plaintiff attorneys sue. Why didn't you tell us about this? Why didn't you know about this? You're the one said the numbers were right, and now the numbers are wrong, right? That goes through the court system. But the partners there are like, holy cow, I don't want my whole life to go down, right? It's worse enough if the firm goes down, my income goes down, but my house, my savings for my kids' tuition, I don't want all of that to be at stake. So you see these different variations of a partnership that come on, like an LLP like that.
Would a family office typically be under like a typical investment firm where it would be an LP that has GPs, which would be the family, or would it be more like an S corporation?
Yeah, I would
Typically.
think so. So the question was a family office. So what you see family offices are is like, you probably have your definition of them. I think of them as they're a little investment house for a very wealthy family. So concentrated wealth that, maybe the patriarch who started the business is elderly or passed away, but there's this huge value creation, and the family needs like multiple advisors to come in and work 8 to 5 on, hey, manage all this stuff. And so that's the way I typically think of a family office. But I would say most of that is probably LP, limited partnership organized, because they do have to, one of the great things about partnerships is you get to treat partners differently. Because a partnership is an agreement and it's a contract. It's effectively an agreement amongst partners, and you got great flexibility in how you craft those things and how you want to, maybe one generation gets this and the next generation doesn't get as much, and they didn't do anything. So those types of things can all be factored into that. So you like that flexibility, and maybe there's not that much liability problem because they may own stock in a corporation that's the family business.
Right.
But just how do you divvy up the rewards that the business might be doing? One of the things I want you to take away from this discussion is there is no right or wrong answer. So just because somebody has an LLC for their business and somebody else has organized this as an S corp, there's pros and cons of each one. And it's what's most important. There's non-tax and tax, and so I just get careful when anybody talks about absolutes. Oh, well, you should do an S corporation. Oh, you should have an LLC. Well, no two businesses are the same. No two owners are the same. What's most important to you? What's your future plans? Where do you want to be in 5 years? What happens if this thing hits that you're making or you're thinking about? Do you want to take that thing public? Do you want to sell it? What's the easiest way to sell it? What's the easiest way to take it public? All those types of things. So just keep that in mind. There is no perfect solution. Everything has a benefit and a downside. So the one thing you do keep in mind when you're talking about legal entities, the formation of these, the requirements differ. Right? Think about the sole proprietorship. I'm doing tax returns in my name. I don't have to do anything. I can start that this afternoon. I don't have to go to the state. I don't have to form an entity. I don't have to pay a lawyer. I don't have to draft any agreements. It's just me. Do I want to do this or not? Whereas if I do a corporation, it's a little more headache. I got to incorporate that with the state because all these entities are typically under state law. You don't have a federal law that typically governs these things. So do I want to do that in Delaware? Do I want to do that in Missouri? Do I want to do that wherever? I have to make all those decisions. I have to draft articles that describe how I'm going to do my business. So it's a little more intrusive. So the legal formation requirements differ. The legal rights and responsibilities, as we mentioned, the liability aspects of these things differ across these. So these are things you all have to think about, and they're legal and tax. And the applicable tax rules is what we're going to spend our time on. Corporations and partnership. The governing the formation is different amongst the entities. The operation of them are different from a tax perspective. The transfer, so nothing stays the same, right? If I decide I want to sell this or somebody wants to buy into this, Buying a partnership interest is different than buying corporate stock, right? And then the liquidation, how do I, sometimes you want to stop a business, how is that different? If I want to stop a sole proprietorship, guess what? I stop doing work. If I want to stop a corporation, it's a little bit more complicated. If I want to stop a partnership, I have other partners. Do they want to stop it? Or do they say, well, hit the road. You can leave the partnership, but you can't stop the partnership. So all these different complexities have to be thought through. And that's why that point about converting business entities over time, you might want to do that as well. Just it's not a one-way street. So there's some exhibits that we're going to go through when we get to the other part of chapter 4 material. They kind of summarize all these really nice. It goes the rows are topics, and then side by side is the columns are the different legal entities. The authors summarize each one of those topics. Okay? So legal formation. Sole proprietorship, you don't have to do anything under state law, right? No formal requirement to start playing music for money, to start selling things on eBay, whatever. Yeah? Keep doing that. Partnership is formed under state law, state partnership statutes with a degree of formality depending on the type of partnership, general, limited, LLP, those types of things. So there can be variations on the level of intrusiveness that the state has on these things. But pretty light touch, I would say, because they're not going to dictate to you the terms of your partnership. One of the great things about partnerships is 2 people, 10 people can get together in a business and decide to structure themselves in a partnership and divvy up the responsibilities, divvy up the rewards as they see fit. The government doesn't impose rigid requirements on those things, which is really appealing, right? Because one person might be bringing in the money, the other person might be bringing in the special skill, and which one's more scarce? Is it a really tight money area where I need an investor, or is it a really interesting idea that's the scarce idea? So those 2 parties will decide amongst themselves how to split the rewards of the business. Yeah. George, question?
Oh yeah, you answered my question. It was about whether there is a cap on the number of partners.
Yeah. So your partners, there's no cap. You just have to have more than one. So it just gets cumbersome. It's obviously 10 partners is 10 different perspectives to manage. PwC 4,000. I tell a story when I signed the partnership agreement. I joked with them, like, well, can I read it? We can suggest some changes. And like, you can choose not to sign it. So it's just because it's not one person is going to be influential in that experiment. Yes, sir.
So for like a PwC, what state statutes do they like fall under?
So I do not know that. That's a great question. I don't think. So no, I was going to say I don't think that's a major deal, but I won't say it is because if there was a dispute, so where you organize it, you have to organize it under state law. So you've heard Delaware, like for corporations and that standpoint, Delaware, oh, you got to be a Delaware corporation. The reason that exists like that is because Delaware corporate law has been built up over time and is viewed as being very pro-business, right? And if you're starting a business, you probably want the corporate law to be as favorable to you as possible. Elon Musk, all his compensation packages and everything, he's been in court in Delaware because he formed Tesla under Delaware law, whether his compensation package was excessive or not. So that's why Delaware was chosen, because it's typically going to defer to the business people. So in the partnership question on your side, I think there's probably some of that, but now thinking back to it, I think actually our partnership agreement said that we were all agreed to be governed under New York law because our leadership was in New York. Our senior partner is always based in New York, and I think that's just because that's the center of the capital markets. So in New York, and we all agreed that if we had a dispute, because I signed that agreement, if I want to sue the partnership for some problem, then that has to go and be governed by New York state law. And I think that was just because the partnership felt like, okay, our leadership is in New York, we wanna be where the dispute is. I don't wanna be drug into Missouri court because Jeff Funkin has a problem with. And again, that's one of those things where the partners agreed to that. And so if you were to go to court, then they would say, well, you guys all agreed that you were gonna defer in the New York court system, so you're in the New York court system. So I think that's the way that would work. But that degree of flexibility of to pick and choose that is so fantastic. An LLC is also formed under state law. Every state, I believe, that has an LLC statute, very simple, online, and you get that. That's either by filing a certificate of organization or articles of organization. Okay, roughly what is the business going to do? Light touch, not hard. The name of the actual document you have to file depends on state law, but it's all about that kind of governance document that's in there. And then a corporation is under state law as well, which you have to file articles of incorporation with the state in which the business is organized. And so that doesn't mean you can't do business in other states. Certainly you do. It's just where is the main company organized under? And so Delaware is very popular for the reasons we just mentioned. Texas is now becoming very popular because it's very pro-business light, regulatory touch. I believe Elon Musk took Starlink, or SpaceX, sorry, out of California and moved them to Texas from an incorporation standpoint. The business did not, like, I'm sure he lifted up some things, but he didn't take all of the hard assets and then put them in Texas. But from a legal organization standpoint, you can change your state of organization. And he did that because he was upset with the California judicial system. Felt like they were too intrusive into his business, which he thinks is his business. Just that kind of thing goes on over time, but you're formed under state law. Doesn't matter, doesn't mean that's where you're taxed, okay? You are taxed where you do business. So he didn't pull all of his California tax liability and place it in Texas. Because place of incorporation does not govern what state you are taxed in, it's where you're doing business. So SpaceX probably wants to be in California because of the coast. That's where we shoot things up in the spaces on the coasts. And he's probably going to still be there. So that activity is still going to be taxed in that state. So non-tax characteristics. So this is an example of one of those exhibits that the authors provide for us. So we've got the types of entities across the top in columns. And then I just want to highlight a few things. So the responsibility of liabilities for the business. So this is the, do I have limited liability or not? And this is, does the liability issue at the business level get transferred up to the owner in a worst case scenario? Either a lawsuit, damages, maybe hurt, those types of things. So in a corporation, entity level, pure limited liability, right? So it doesn't transfer up. LLC, the same. The partnerships you see, general, only the general partners are the ones that are liable, not the limited. Sole proprietorship in the far right, there is no limited liability. So if I put my shingle out and I do tax returns and I do a terrible job and I file a bunch of terrible tax returns and clients get really upset with me and they all sue me, there is no legal entity. It's a sole proprietorship. I'm liable for whoever can get in a court to tell me that they win and I'm liable. So, and would I want to do that as a sole proprietorship, or would I want to set up an LLC? Because then maybe my $10,000 I put in to get my copier and my software and everything ready, that's all I can do. And if I get sued, then you contracted with the LLC, not me. Limited liability. Okay. But now I have to do a little bit more than a sole proprietorship. So that's where when you're talking with your friends, it's like, what are you doing? Are you you're doing something that's likely very dangerous, transportation, but if you're doing something that's, chemicals that are harmful, if there's a spill, those types of things, that's where the liability might take a higher importance on the standard. I just want to keep it simple. I'm just playing music. Who's going to get sued playing music on the weekend? You're not tipping. Okay, the next row here, legal arrangements amongst the owners. Corporation, not flexible. Okay? The articles of incorporation are the articles of incorporation. That will talk about how do I treat the different owners of the business. So think of a publicly traded company where the shares change hands every day, all day long. I can't say, I want to do this with this shareholder and this with this shareholder. Now, I could have different classes of stock. That will give me some flexibility there, but many companies have one class of stock because analysts hate multiple classes of stock because I can't really get a value of the company. Right? This has been a complaint on Facebook/Meta for many years because Mark Zuckerberg has a special class of stock. It's his company, he started it, but he gets like super votes. So yeah, it's a publicly traded company, but any vote of any material matter, he either approves it or doesn't because he's got this super vote. And so from a governance standpoint, that can be kind of difficult to think about as opposed to a company that's got one class of stock and it's like an idea gets brought in front of the shareholders, you all vote. And majority wins, right? So as a general matter, corporations are very inflexible from treating different owners different. Contrast that with the partnerships here. Very flexible, right? I mentioned a contract amongst the partners. However you want to divvy the things up. If you guys are doing a bunch of sales business that you've developed and somebody wants to take the Illinois market, somebody wants to take the Missouri market, and you're going to partner up and you want to give 90% of the Illinois results to this partner and 5% of Missouri and then vice versa to the other partner so that you're incentivizing one to concentrate in Missouri, one to concentrate in Illinois, have at it. Government doesn't get involved. That's your contract between the parties, right? So that feature is very appealing to business people, being able to structure how we relate to each other. And suitable for initial public offering. So an IPO is taking a previously private business, right, and becoming a publicly traded company. It's shocking some of the biggest companies in the world as to how, in the grand scheme of things, of what size they were 20 years ago. But they had to become a publicly traded company at some point. I think this year we have shots at some massive companies, SpaceX, potentially doing an IPO, and ChatGPT doing an IPO, OpenAI, becoming an IPO. With both of them, maybe have a shot at being $1 trillion IPO on day one, selling their shares to the marketplace. So what's important here is the corporation is the only one of those entities that is publicly traded. Okay? Just from that feature, because partnerships don't become publicly traded. But I'll pick on PwC again. We didn't want to be publicly traded. We wanted to be the owners and govern how we do our business amongst ourselves. We didn't want you guys to buy stock in PwC. Okay? But if you're going to go public, then you need that flexibility to have your ownership change hands on an exchange. Right? Partnerships don't allow that because it's just like when I retired from PwC, I sold my partnership interest back to PwC. Why? Because the partnership agreement said I was precluded from selling that to any third party. Because I had to be voted to be a partner. They didn't want me to say, well, my neighbor wants to be a partner in PwC, I'll sell it to him. So, but I could sell my Apple stock to my neighbor, right? That's a corporation. So you can see the push and pull. One has a lot of flexibility, but it has some liability concerns. One has no liability concerns, but a lot of flexibility from an IPO perspective. And So that's why you see, you start off maybe as an LLC, maybe your idea or your product catches fire and you're like, oh, I want to be a public company in 10 years. You might have to convert to a corporation. That's where things get expensive and complicated and you start hiring a bunch of young, smart people to help you do that type of stuff. Okay, so non-tax and tax, it's a blend of the two. So what you end up wanting to do. So let's talk a little bit about separate tax-paying entity and flow-through entities. So a separate tax-paying entity is the entity itself is a taxpayer in the eyes of the government. So it files its own tax return, reports its results, pays its tax, irrespective of if it gives anything to its owners. And the results of the entity do not affect the tax results of the owners. Right? So there's nothing flows through it. If I own stock of Apple, Apple files its own tax return. In its name, pays tax. If it has a great year or a bad year, nothing directly impacts my tax return. Okay? Contrast that to a flow-through entity. Flow-through entity, the entity itself pays no tax. It does business. It has an income statement. It's got income, it's got expenses as a business. But then it reports that out to its owners. It flows through to its owners. The owners pick up that income along with anything else they have non-business wise on their tax. During my time at PwC, I had my own stuff that I had, savings, my wife's job, all that stuff went on our tax return. PwC results went on that same tax return. My small share of that. Okay? If PwC did well, my numbers are higher. PwC did bad, my numbers down lower. Right? All flows through me. PwC never paid $1 of tax. Why is that important? One of the things you're going to see here when we talk about corporations is we got a double taxation issue. The double taxation issue, if you're in my individual or my international tax course before this course, we talked about double taxation today. This is another different, separate, distinct instance of double taxation. The problem here is the corporation, the business, makes $1 of income, pays tax at 21%. And it has, in many instances, leftover cash at the end of the day. It makes investments, hires people, great things. It has excess cash. One of the things they do, they might make a dividend of that excess cash to its shareholders. Dividend income, in my taxation of individuals course, included in gross income and taxable, right? You pay tax on that, so that $1 of business income was subjected to 2 layers of tax. Corporate level, after tax earnings were distributed, taxed again. Double taxation. That's a big downside to corporations. Right? Good side, publicly traded, multiple owners, very flexible, great for stock options, hiring smart people, rewarding them accordingly. Getting the earnings to the owners very ugly from a tax perspective. Partnerships, 1 layer of tax because it's flow through, right? Nothing at the business entity. That's why all the accounting firms, they have tax people. They want to be partnerships. 1 layer of tax. So we have to deal with this not being public. We have to deal with the liability issue. S corporation. We talk about S corporations. Formed under corporate law, under states, like any other corporation. But I elect under the tax code to be taxed as an S corporation. It's an election that only has effect for tax purposes. Nothing changes from a liability perspective. But it effectively negates the double taxation issue and has 1 layer of tax, so it treats it as a flow through. Meaning that the corporation, the S corporation, doesn't pay tax. It acts like a partnership. It does its income statement, distributes that out to its shareholders. Why do the family of Coke, family founders of Cargill, they like it to be closely held, not publicly traded. They want to minimize tax. That's how the whole S corporation regime came about, is to give them what they need, not them, but in general, that segment of the business community, what what they want, which is one layer of tax without all the tax problems of double. Yes, ma'am?
You mentioned a lot of them trying to do the partnership option.
Yep.
Is that, I mean, it sounds like that one layer of tax is beneficial for any kind of company, so why is it like accounting firms doing that more often? Is it just tradition or something different about how they operate?
I think it's probably the, why it's appealing, let me start on the affirmative. The why it's appealing for accounting firms is that flexibility of arrangements among the owners, because all the partners are compensated differently. Now, they might be bucketed if they get so big that we don't want to treat 4,000 partners each individually different. We want to partner A class, partner C class, those types of things. But we like that flexibility of being able to do that. And we like that minimized tax. Because these are usually people are doing very well and they want to try to pay the least amount of tax. Because if you weren't in individuals, the top individual corporate tax rate is 37%. So if you have a corporation that's paying 21%, those after-tax dollars are distributed up to an individual shareholder who is at a 37% bracket. Get a haircut pretty good on your business income. Whereas if I could just limit that to 37, one instance for the top bracket, then maybe that's the best answer for that. Now, your wider question of why isn't that more appealing to a lot of businesses? I think because major big corporations are typically public. And why are they public? Well, you don't have that family ownership anymore. Maybe it's somebody started it, but maybe it's just not held in the family. So like Apple was started by individuals, obviously, but now it's not run by any family. It's widely owned. So what being publicly traded does is it gives you access to the capital markets to grow your business at scale. And it gives you the ability to do stock-based compensation to your leadership in the business, which is, why is that really important? Although I held a partnership interest, it wasn't liquid. It wasn't marketable. Like I said, I couldn't sell it to anybody. Now it was valuable. I could go out and borrow money, and that's an asset, I would say. But if I'm a executive or a high-level individual and I work for Microsoft, I get stock options, man, that stuff is liquid gold, right? As soon as all my impediments of vesting and all that stuff settle out, I sell that stuff today. Bang, right now I got cash, right? So that's really appealing to try to incentivize the smartest people to work for your business. And those types of big companies, there's a lot of competition for that intellectual portion.
Are the CEOs of accounting firms also partners?
Yeah. So they go by different names. PwC was senior partner, but that person was just a line partner. Line partner, that's like, I always thought of myself as a line partner. I was on the front lines dealing with clients, but the senior partner is running the firm like a CEO, just like a CEO. This is a multi-billion-dollar operation. But the partnership agreement would give them more income. And so, yeah, they would be technically partners in the partnership, but the partnership agreement would give them a greater return. Not just greater returns, but it divvies up the responsibilities amongst them. What was that person supposed to be doing? They're supposed to be dealing with the government, dealing with litigation matters, dealing with client things, not day-to-day things, but client matters, those types of things. So with rewards comes responsibility, just like the CEO. So different partnerships might call them different names. They're all technically, legally partners. Okay, great questions. So the one thing I put here in the bubble, you'll hear people talk about pass-through. Pass-through is the same thing as flow-through, same thing as partnership. It's just that function of the entity doesn't pay anything, it passes through to the owners. Okay. So separate entities and pass-through. I highlighted here what we're going to be talking about. We're going to be talking about corporations, partnerships, and S corporations. Sole proprietorships, taxation of individuals. Okay, legal form versus tax treatment. The legal form, in certain instances, may not be indicative of its tax treatment. We've talked about S corporations. An S corporation and a C corporation are both corporations. the non-tax implications are exactly the same. The tax implications are vastly different. You don't have to be an S corporation. It is available if you make the election to become one. Now, there's certain requirements you have to have, which prevents you from being the number of shareholders prevents you from being publicly traded. But that's what will govern whether you make the S election or not. So it's hybrid. Its legal form, corporation, is different than its tax form. Okay? LLCs, extremely flexible from choosing your tax classification. That's why you hear it all the time. You hear it amongst entrepreneurs, startups, people running their own business. Very, very flexible from choosing your tax. But each LLC is a function of state law when you form the LLC. It has limited liability in its name. So I could choose my sole proprietorship when I do the my own shingle and I do Jeff Plunkett CPA doing tax returns. I could form that as an LLC. Jeff Plunkett LLC Tax Return Preparation Services. What that would mean is I formed an LLC and I'm doing business in the name of the LLC. I can do that as a single owner of that LLC. And I could limit that liability, right? Because it's going to put that wall. Something if I do a terrible job, okay, I have a limited liability, right? If I want to do that. I could have two people who do a tax return. So you guys could grow up to be tax people and you and I decide to do tax returns. We could form that as an LLC and we could make that LLC be a partnership. Because LLCs are very flexible. We'll go through. I can choose my tax classification. So long as I have one owner, more than one owner, I can make it a partnership. I could do an LLC. So you'd say, well, why are accounting firms partnerships instead of LLCs? Well, first of all, because partnership law has been around for eons and these firms are very old. LLCs, in relative speaking, is more recent. So they weren't around when they were doing these things. Plus, an LLC doesn't have that flexibility nearly as much as a partnership. Being able to distinguish amongst partners for compensation and responsibilities. Right? So it's just choosing those ways there. So LLCs are really good from a liability protection and then choosing the way I want to be taxed. Yes, sir.
Would a lot of like banks, hedge funds, like Wall Street investment firms, is there just like the accounting firms typically have one kind of like take one form? Like, is there kind of a standard for?
I think you find a lot of limited partnerships in those scenarios because think about how complicated those investment structures can become. They want lots of flexibility because they're trying to cater to different investors. And so that partnership element of flexibility is really, really appealing to them. And you can make it as complicated as you want. Now, you can make it really complicated such that it might put off some segment of investors because I read that and I don't even know what it means. But if you have investors already lined up, then maybe you're just catering to different investors in that perspective. So again, I don't like to speak in terms of absolutes, but I would think in that space, a lot of flexibility would be the key. There are different ways you can manage liability because you could put LLPs over LLCs and stuff like that. So you see these things stacked on top of each other as well. That's when you get these crazy org charts. And again, job security for legal people, investment people, and accounting people, and tax people, because you gotta understand how all this fits together. So, the flexible entity classification election, our last topic for today, drives additional disparity between legal form and tax treatment. So, you have a default tax classification for each legal entity. But if it is, in certain instances, you can choose something different than your default classification. So, the simplest is a corporation will default to being a separate tax-paying entity. And a corporation, unfortunately, is not allowed to choose its tax classification other than accepting the default classification. Always separate taxpayers. LLC, you can choose to be a corporation. You can choose to be a sole proprietorship. You can choose to be a partnership. Solely for tax. Entity classification is a tax election. It doesn't change your relationship to anyone that you're doing business with except the U.S. federal government. Okay? So if you get sued, you can't say, oh, well, it's this or that. That's a tax classification. What did you do from a legal perspective? But knowing that tax is a big driver of your choice of these business entities, this is very, very, very nice. So this has been around for several decades, 3 decades. We've had an entity classification election. So Exhibit 4.2 depicts the potential application of the entity classification election in decision tree format. Real quick, I want to go through this. So going from the top, and by the way, the authors do have a fantastic set of appendices, usually where they do decision trees. I like things, my brain really likes compartmentalizing things, so I like visualizing, okay, I can kind of see how all this fits together now if I just start with questions. I get down to the answer, I see the subtle differences. So let's start at the top. Is the entity a legal corporation? Did I form it under state law as a corporation? If I say yes, going down the right side, did it qualify first and second, affirmatively elect to be an S corporation under the law? If it's yes, S corporation, my legal entity. If no, C corporation. I think that's pretty simple, right? Form it under the, but that's the only flexibility I have when I start with the corporation. I have to meet the the S corporation criteria. The major one that people differ with is I think I have to have 1 class of stock and I can't have over 100 shareholders. So think about that middle right S corporation box. It doesn't work for publicly traded companies. I don't know of any publicly traded company that has 100 shareholders, right? You might start off with 100 and then day 30, you got 200. Then it just morphs and keeps going. You know, people just buy and sell stock all the time. And so there's an inordinate number of shareholders. So that frustrates S corporations from being publicly traded, that limitation. That's just under the law, that's all. So go down the much more interesting side, down the left side. So is the entity a legal corporation? The answer to that is no. Did the entity elect to be treated as a C corporation? I can choose to form it as a partnership, an LLC, and then choose to elect for it to be taxed as a corporation. That's this entity classification election. So I could start down the left and shoot over to the right. Why would that be important? Maybe I want the flexibility of my governance, compensation and responsibilities to look like a partnership, but somehow I want it to be a corporation. Maybe I don't care about the double tax issue. I can elect for that. Let's say I don't elect for it to be a corporation. I go down the left side. So I did not elect for it to be a C corporation. Does the entity have more than 1 owner? If the answer to that is yes, then I'm a partnership. If the answer is no, is the owner an individual? If the answer to that is yes, then I'm a sole proprietorship. If it's no, then I'm treated as the same as the owner, not a separate legal entity from the owner. Almost like a sole proprietorship. That middle box down there in the bottom is a branch. So the way I like to think the left-hand side is really an LLC. That's where you're going to see it the most. I don't form it as a corporation. I'm an LLC. Do I have more than 1 owner? Partnership. If I have 1 owner and it's an individual, and it's a sole proprietorship. I have more. If I have no, then it's not an individual. Then it's a corporation owner. Then it's treated as a branch. This is the flexibility we have in this area. And it's a combination of non-tax and tax. Okay, so we'll pick up on this on Wednesday, sorry. And for those of you that have not been in my classes, I always send out in advance what we'll be covering next week. So that you can do some of those hours before. preparation for that, but we'll meet next Wednesday. Okay?